Hello and welcome to Morningstar. I'm Emma Wall, and joining me today to give his 3 stock picks is Alex Wright, manager of the Fidelity Special Situations Fund and the closed-end fund Fidelity Special Values. Hi, Alex.
Hi.
So what's the first stock you'd like to highlight today?
The first stock I'd like to talk about is Shell, the oil company. So this is the largest stock in special situations today, about a 6.5% position. And the key reason I like it here is the sustainability of the dividend yield. So this yield's about 6.8% today, is one of the biggest dividend payers in the market. And I think that dividend yield is very sustainable at $55 to $60 oil, which is where we are today. And additionally, there's a lot of production growth coming through primarily because of the BG acquisition, and that is production at very low prices. So effectively, the cost of that production is very low, and so earnings for Shell are growing over time, irrespective of the oil price, given that growth coming out of the Brazilian assets of BG.
And what's the second stock today?
Second stock I'd like to talk about is Royal Mail. So this is about a 3% position in special situations today. I think the key attraction of this stock is, first of all, a lot of people miss, but this is a regulated utility, and the regulator is charged with maintaining a 5 to 10% margin for the company. So while there are a lot of moving parts over time, actually this is a company that should consistently be able to do that. Today they're only doing about a 5% margin. The valuation of the stock on that low margin is only about 10 times earnings, about a 5.5% dividend yield, and I see certainly over the medium term them consider being able to continue to produce these sort of profits that they do today.
So utilities generally tend to kick off a nice looking dividend yield but not much share price growth. Is that fair for Royal Mail?
So I think Royal Mail sort of standalone is unlikely to produce much top-line growth, but in terms of efficiency, I think there is a lot of a scope to improve the efficiency. So that 5% margin is the lowest of any postal name in Europe, and I think that is a legacy of the fact that they were privatised a lot later than any of those names, and therefore there's more scope for them to invest and improve margins over time. And clearly the fact that the bottom end of that regulated 5 to 10% band shows the potential that if that really works out well, over maybe a 10-year time period, you could double profitability.
And what's the third and final stock?
The third stock I'd like to talk about is Ultra Electronics. It's a mid-cap FTSE 250 stock, which primarily plays to defence end markets. A company that really has lost its premium rating due to some prior contract issues in Oman. I think those are now past it. We're seeing a much better defence environment with growth, particularly out of the UK and US budgets, and increasingly from the Middle East and other NATO partners as well. And they also have a big simplification programme, which is improving margins and synergies coming from a recent acquisition.
You said the keyword NATO there. I was going to ask how sensitive to geopolitical risk is this stock, meaning particularly the Middle East. But the thing about NATO is we've now got Trump in the White House who's threatening to leave this, that and everything. Do you worry about that sort of thing with this stock? You know, the threat of kind of geopolitical risk either from the US or indeed the Middle East?
I think basically geopolitical risk is generally positive for defence spending, and I guess more uncertainty creates more desire from countries to spend. So particularly with Trump talking about maybe not honouring NATO commitments, that clearly pushes sort of NATO members to want to spend more on their own defence if they're worried about the US sort of not stepping in to support their aims. And the US itself, as obviously the biggest defence spender in the world, is committed to spending more themselves. So I think if the current environment continues, it's a reasonable demand outlook. There is the possibility that those events may push that to be a very good demand outlook.
Alex, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.